The Federal Reserve just announced they're going to try to take rates to 5.1%. The yield curve is showing us that a recession is likely very near. The latest CPI numbers have gone down. So we have to ask the question, is deflation next? Is that something we should be worried about? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go right to a bombshell report from the Federal Reserve themselves showing that we could go from a money boom to a money bust. Look at this chart going all the way back to 2000 to today's date. Well, just a little before today's date. More on that in just a moment. On the left, we go from 4 trillion all the way up to 22 trillion. This is a chart of M2 money supply, and we can see that it grows pretty consistently. We see this trend line all the way to 2009 or so, GFC, and then that trend line flattens out, but then goes up at a steeper rate until we get to the cerveza sickness, and most of you guys know what happened. M2 money supply, the currency units that were circulating in the real economy, chasing goods and services, went parabolic. In fact, this broad measurement of the amount of money in the system went up by 25%. Obviously, this increased aggregate demand tremendously. And let's keep in mind, at this same time, the federal government was coming in and locking everyone in a cage. So they are destroying the supply chains, reducing supply, increasing demand. What are you going to get? Massive consumer price inflation, which is what we've seen over the past year and a half. To better assess the probabilities of us moving to deflation, where prices are coming down, especially asset prices, we have to go back to this time frame when the money supply went parabolic, the money supply as measured by M2, and figure out how this happened and if it can work in reverse. Everybody knows what goes up must come down. And although I would admit that very rarely applies to the money supply, it definitely can. So if we had a money supply boom that led to massive inflation, we can also have a money supply bust that leads straight to deflation. Step number 2. Now let's go to this bombshell report from the Fed and go through the details so we can figure out exactly how the M2 money supply went parabolic. And if you're saying to yourself, oh, George, I already know how it went up so much. It was because the government printing money. Not exactly. Editor, let's cut to the internet. We are right here on the Fed's website, federalreserve.gov. Title, Understanding Bank Deposit Growth During the COVID-19 Pandemic. In this note, we present evidence that 4 factors can largely explain the growth in bank deposits over the 2-year period from 2019 Q4 to 2021 Q4. So here they give the 4 things that they believe led to this spike, and we're going to focus on 2 of them because I think they're by far the most important. So first, the initial spike in commercial and industrial credit line drawdowns at the onset of the pandemic. So this means that businesses were freaked out because they thought the world was ending, and so they went to their bank and said, hey, I need as much cash as possible. So if XYZ small business has a $250,000 line of credit with the bank, they're going to go over there and say, hey, I want the $250,000 ASAP. So when the bank extends the credit, then this creates additional M2 money supply. Not exactly government printing money, at least not yet. The second thing they point out, asset purchases by the Federal Reserve. Okay, so this is what we're going to focus on. Asset prices by the Federal Reserve and the extension of additional credit. And I know a lot of you that are paying attention are saying, all right, George, okay, well, when the Fed comes out and buys assets, that is quote unquote money printing. Maybe, maybe not. Let's keep going down the article. And here we see the key point I'm trying to make. And I've tried to make on countless numbers of whiteboard videos. And you guys may recognize this. The asset purchases by the Federal Reserve led to the creation of reserves in the banking system. Okay, but this is just a bank reserve on the balance sheet of Goldman Sachs, JP Morgan, etc. That doesn't mean that it's an increase in M2 money supply. In other words, it doesn't increase the amount of currency units that are circulating, chasing goods and services, which could lead to consumer price inflation. Let's keep going. And to the extent the Federal Reserve purchased the assets from non-bank entities, they also led to the creation of deposits. You get what they're saying here, guys? If the Federal Reserve buys a treasury or mortgage-backed security from a bank, it does not increase M2 money supply. Period. End of story. If the Federal Reserve purchases that treasury or mortgage-backed security from the average Joe and Jane in the real economy or a non-bank entity, it does increase the money supply. So if you really want to get a handle on how this works, you can't just ask the question, who is buying? But you have to ask the question, who is selling? Oh, but wait, there is more. Check this out. In the second half of 2020 and 2021, banks themselves rapidly expanded their holdings of both U.S. Treasury securities and agency and GSE-backed securities, things like mortgage-backed securities, as reflected by the red line in Figure 4B. Editor, go ahead and throw that up on the screen. So now we have to ask ourselves the question, is there any difference between a bank buying from a non-bank entity and the Federal Reserve? The answer, no. So if a bank buys a treasury from the average Joe and Jane, this increases M2 money supply as well. I know a lot of you watching are saying, okay, George, I get it, but what's the big deal? Why does this matter? Because right now the Fed is doing quantitative tightening, which means instead of buying the assets, they're selling assets back to the non-bank entities, potentially, in the private sector, the average Joe and Jane. So if buying makes the money supply go up, then selling would make the money supply go right back down. Especially when you combine this with an economic recession, which would prompt the banks to lend a lot less. And if the banks are lending less, that means there's fewer currency units being created, and M2 money supply goes down even faster. And if the amount of currency units increasing led to inflation, the amount of currency units decreasing can lead to deflation. Step number 3. Now, if we look at an updated version of this chart, we can see the money supply as measured by M2 is actually decreasing. And this most likely has a lot to do with the fact that the Fed is doing quantitative tightening. But we also have to take a look at what bank credit is doing right now. Editor, go ahead and throw up a chart. And we can see that it's still rising at a very rapid rate. But if we go back and look at past recessions, we see that it flattens out or goes steeply negative. So if the Federal Reserve continues with their quantitative tightening program, and remember, they've got trillions and trillions of treasuries and mortgage-backed securities to sell that could decrease the money supply. If they're doing this at the same time, we go through a recession and the banks are issuing less credit, that exacerbates the problem even further. And if we remember that this decrease in the chart that we could see go down just as fast as it went up represents aggregate demand, you see very quickly how we could go through maybe a very short period of considerable deflation. Whoa, time out. I know a lot of this can get confusing, so I want to review just quickly with this diagram so you understand how the Fed and the bank selling can or cannot impact this number, this chart of M2. So we start with the Fed buying from a bank. Okay, well, the Treasury goes over the bank's balance sheet and the bank has to pay for that Treasury. But remember, they have an account, just like your checking account, with the Federal Reserve. So the Fed simply decreases the amount, the balance in their account to pay for the Treasury. This reduces M0, base money, but it has nothing to do with this key metric. Why is it key? Because this represents the currency units that are chasing goods and services in the real economy that can impact inflation and deflation. So now let's think it through. If a bank buys from the average Joe, so the average Joe has a checking account with the bank, just like the bank has a checking account with the Fed. So the Treasury goes over to the average Joe's balance sheet, but what does the bank do? In order to pay for that, they simply reduce the amount of money in Joe's account. And this reduces M2 money supply. So with this transaction, the dollars circulating in the real economy were not impacted. With this transaction, they were. Okay, now let's go over some of the wild cards that we haven't yet discussed in this video, but definitely do impact the probabilities of us seeing deflation in the very near future. First and foremost, how about foreigners selling into the US market? Well, they're going to take those dollars, and what are they going to do with them? They're going to take them out of the country. What is that going to do to the circulation of currency units within the domestic economy? Goes down. Also, the supply side of the equation. I know a lot of you are probably saying to yourself, or have been throughout this video, George, I understand that the demand side can go down, but what about supply? Supply of everything is at an all-time low, and I totally get it. But if this plays out, we go into this recession and we have aggregate demand absolutely plummet, we can see it go down much faster than the rate of supply. Keep in mind, lately, that supply has been flatlining, if not slightly going up. But lastly, and maybe most importantly, something we addressed right at the top of the video, interest rates are going higher. And it's not just the fact that the Fed might raise rates to 5.1%. That's their projected target. But it's the speed, it's the rate at which they have increased interest rates. And this is truly unprecedented. We have never seen anything like this in the United States going all the way back throughout the entire 1900s. To illustrate this point even further, editor, let's cut to a clip from my good buddy, Mike Maloney.
Now, this one, look at this. 8,200% change over a year ago. And this one goes all the way back to 1934. So now we have 88 years to compare. Nothing like this has ever happened in the history of the United States. And this has me very, very worried that something is going to break. And I'll show you exactly how horrific the consequences will be this time around. Lehman Brothers, the 2008 global financial crisis, walk in the park compared to this.
So will we definitely see deflation throughout the economy? Nothing is certain. This is only a game of probabilities. And I think my base case is that we will see disinflation if we continue to have a soft landing, let's say. But we could see deflation if we have a hard landing, black swan event, or another financial crisis. But overall, throughout the 2020s, I think we'll look back on it and see that it was an inflationary decade overall. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.